in a 2-wheel drive pickup, I'm not going to get there.
You might get there.
Might.
Yep.
I'll call you.
All right.
Carson, come pull me out.
Hey, it's good to see all of you here this afternoon. As I was mentioning, I really like this format better. And if you don't mind leaving your webcam on, that would be fantastic. That way I get a feel for your reaction as we go through the material today. I've got the recording started. I'm assuming that all of you, in addition to seeing me, can also see the PowerPoint slides. Okay, I'm getting some head shaking up and down, so that's great as well. So welcome to our second session. I'm kind of excited about today. We get to start talking about using the futures market, and that's always fun and kind of an exciting place to be in terms of marketing. Lots of things going on in prices and futures markets now. Very typically when I offer these classes this time of the year, the markets are dead. They're just solid dead, but not this year. Boy, lots of things are going on, a lot of volatility in the market, a lot for us to talk about. So that really makes this whole process enjoyable for me. So just to do a little bit of a review from what happened in the markets last week. And these really was a set of questions that came up from the end of last week. One of the things that people were asking, especially Friday, has the corn market made a top? It really looked like it had. We were starting to see a couple of things happen. One thing we'd seen is we'd seen the market get close to a trend line down, which was starting to make us believe that maybe we were going to go below that trend line. So that's a concern. We saw the number of contracts being traded come down to some degree, which starts to tell us that there may not be as much upward potential in the market. And then China canceled an order for corn. Now, it's not this year's corn, it's next year. And so although that shouldn't have a direct effect on old crop, it does have an effect on the overall psyche of the market, so to speak. And the other big thing that came out last week is we're sitting on some pretty substantial stocks of ethanol. And so that tends to make us believe that market has got a top to it and prices are going to come down because the ethanol plants aren't going to be as aggressively buying corn for a corn crush. So that was the question in corn. Now, what a difference a weekend can make. If you watched the corn market yesterday, it soared. It really took off. And now people are not talking so much about the market making a top. In fact, we took out some highs on some of the contract months. And so corn is looking quite a bit different as of Monday. Today, the markets are off a little bit, but it's more a profit-taking loss. Those day traders kind of ran that market up and they sold off and made a little bit of money. So not thinking that's a fundamental difference in what's happening with the market. The second question was, will the strength of the soybean market take acres from corn? That question is still out there the beginning of this week. And I've heard some rumors that a couple of pretty well-placed sources are thinking that the corn market or the corn acreage this year will be about 92 million acres. If that's the case, that is a very bullish number, and that could have a pretty strong effect on bringing the corn market up. Now, we'll probably not really confirm that until the planting intentions report that comes out the 31st of March. But people are already starting to talk about 92 million acres. The idea being that soybeans are going to pull corn acres away in the Midwest. And then there's some talk that in the Dakotas, North and South Dakota, that those producers are probably going to be more looking at producing and planting spring wheat. And if they plant spring wheat, that's going to pull acres away from corn. Obviously, the wheat prices are strong, and wheat certainly is a less expensive crop to raise in terms of inputs. That's an area that typically doesn't put down a lot of fall nitrogen, unlike the Corn Belt. And so they've got a little more flexibility. So there's a lot of thought that the Dakotas will go spring wheat, not corn. And again, that would reduce corn acres. Certainly, Russians and tensions involving Ukraine have really been driving the wheat market. And every time it appears that Russia's on the cusp of doing something, we see that wheat market react and go up. And then if we hear news that maybe we're negotiating a peaceful resolution to that issue, then the market goes down. So that's really got that wheat market in turmoil. And my guess is it will continue to do so until that's resolved or they invade one way or the other. And then finally, we've seen some pretty substantial reductions in our cow herd at all levels, cows, calves, throughout the cow herd. And again, it's primarily as a result of drought conditions last year. The interesting thing about what we've seen with our herd numbers in this country is when we have a substantial reduction, and most of those have been drought driven lately, once the market improves, conditions improve, weather gets better, we never see those cattle markets get up to the point that they were before. It seems like, especially as people liquidate herds, if we're looking at an older cattle producer, they decide, this is a lot of work and I don't know whether I want to do it anymore. And so we don't see the numbers come up. What has happened is we are still maintaining the ability to produce beef at a relatively stable level. And that's just because even though we're ratcheting down that beef herd, we're improving genetics, we're improving efficiency, and we can produce the same amount of beef with fewer cows. So numbers are coming down. Total production isn't as reflective as it would have been in the past. So again, lots of questions from last week. Any questions any of you might have, comments, things that you've noticed as you've just been looking at market prices as we go forward? Okay, good question about trend lines. Actually, those charts are custom design charts. I get those from our market specialist on the CSU campus. He's actually going to speak with us 2 weeks from today, and he'll probably have updated charts with him. And I will ask him if he can provide those charts for me as we go forward, but that's the source of those. So sometimes that Brock report will give charts that do have some trend lines with those, but they're a little different than what I would get from Dr. Kuntz on the CSU campus. But we will see if I can't provide those for you.
Thank you. I also, I don't know about everybody else, but when I signed up for GeoGrain, I got a 3-day window to play with it, and that was it. So I don't know if I did it.
Only 2 days. Okay.
Yeah, 3 days.
Three. Oh, wow. Have any of the rest of you done that?
Yeah, I tried it too. I got in about 6 or 7 o'clock, and that was day 1. So you really only get about 2 days of use out of it.
Okay. All right. Well, I hate to hear that. I think that was, that's probably an issue with their marketing. The 14-day, I think, was great because then you could really get a feel for how it would work. Let me see if, and I think I'll be able to, I have a yearly subscription. Let me see if they will allow me to pass some things along to you as I'm doing with both the Brock report and with cattle facts. And that way, at least you'll kind of have an idea kind of what's going on. When you went through the free trial, did they give you the subscription rate? At one time, it was $25 a month. They didn't give that. Let me do some checking. I'll call them and see if we can't work something out for the class, because I'd really like for you to have a couple of weeks to look that over. I think it's a valuable tool, but 2 or 3 days is just not nearly long enough to evaluate it.
Yeah, it took the first day to figure out how to even get to the max. And they weren't nearly as sophisticated as what you were showing us. Like I could get very little detail.
Okay.
There was an email from one of their marketing people asking, what am I looking for and how might they help me?
Yeah.
But no prices were shared.
Okay. Okay, well, let me follow through on that. I'm disappointed that they're not doing as good a job as they did before, but let me see what I can work out. Great. Any other questions or comments, markets last week? Okay. Questions from last week, just a quick review. Again, we talked about cash markets, reading online bids, a lot of time spent on basis, but hopefully after last week, you can see the importance of that. Some ideas of how you can track local basis, becoming familiar with forward contracts and how to evaluate those. Questions from anything we covered last week?
Are there certain contracts that are more closely or more popularly used with certain commodities?
Yeah, there's certain months that are called the bellwether months. And that's a great question, Rhonda. Typically, those months are the nearby month to when we typically harvest a crop. So for example, in corn, December is your bellwether month. In wheat, the July market is a bellwether month. And in soybeans, it's November. And the feeder cattle, I think the October feeder cattle is the bellwether month for that particular contract. Now, having said that, those are for us, for most of the Great Plains and the Corn Belt. If you're a corn producer, for example, say in Texas, you might want to trade the September corn contract because that contract is closest to when you're going to harvest corn in Texas. So that varies just a little bit. But again, for most of the Great Plains, Corn Belt, including us in Colorado, those would be the months that we would be looking at. And the whole idea behind that, as we'll get into in just a minute, is we want to have some kind of price risk from the time, actually we can do it years in advance, but at a minimum, we want to have that price risk in place during the growing season. So until we cash market that crop, there's a risk that price will go down. And so we want to, in a hedging situation, utilize a month that would allow us to cash market our corn and offset our futures contract within a few days of one another. As soon as that corn is cash marketed, we no longer have price risk. And so we no longer need that protection that futures hedge would provide for us. Conversely, if we do a forward contract, the grain merchandising company or feedlot or whomever offered that forward contract and contracted with you, they're going to take a position on the board to get to take away their price risks as well, because when they've told you I'm going to pay you $5 a bushel for corn, they now have risks that price could go up and down and go against them. So they've got to lock in a position. So they're going to use that December contract as well. Other questions? Very good one. If you've been doing the basis tracking, again, it's optional, but that's kind of where we are now. If you look at that far column to the right, it's been very interesting what basis has done. As you can see in corn, basis is narrowed. In Haxton, it's narrowed by 30 cents. That's kind of unusual. Pretty good narrowing of basis in the cattle side as well. And we actually had a 15-cent basis change in corn at Pete's. It went from 5 cents under to 10 cents over. So that shows that the local demand, the demand we have currently for commodities is pretty good, in that we've seen that much of a change in basis in such a short period of time. Again, to reiterate those 5 common marketing mistakes, and that's going to be kind of the backdrop that we use for organizing the class. We talked about number 3 last week, failure to understand and track local basis. And what I'd really like to concentrate on today is reluctance to pre-harvest price commodities. And again, forward contracting, as we talked about last week, is a tool to help you pre-harvest price commodities. And then today we're going to introduce to you a new tool, that being the futures market, again, is a way for you to pre-harvest price commodities. And hopefully by the time we end today, I'm going to have convinced you, I hope I've convinced you that you really need to look at this opportunity to pre-harvest price commodities. So let me give you some actual data to hopefully convince you this is something to consider. And this is some information, again, that Ed Usset put together. But what Ed did is he looked at that December corn futures market, the price, and he looked at it from 1990 to 2014, and he checked it just 2 days. What was the price May 1st for that December contract, and what was the price October 1st? And what he found was in 19 out of 25 years, or 76% of the time, the price was higher in May than it was in October. And 3 of those 4 years, it was a 29-cent bushel difference. So if you produce corn, pre-harvest pricing your corn is a no-brainer, in my opinion. 3 out of 4 years, this is going to pay you dividends to do it. Now, there's that odd year, that anomaly year, where this doesn't happen. And actually, last year was an anomaly. We sold corn off our truck at harvest at $6, and we had pre-harvest price corn below $6. So that didn't happen last year. That was the 1 out of 4 years that it doesn't. But 3 out of 4 years, this will work. And so if you're a corn producer and you don't pre-harvest price corn, you're really missing out. How about soybeans? Well, it's not quite as definite with soybeans. 16 out of 25 years, or about 64% of the time, but that average difference is a little higher. It's close to that 31 cents. So even as a soybean producer, you really ought to look at this. Wheat is a little different story. Wheat doesn't tend to follow the really strong seasonal patterns that either corn or soybeans follows. So this is actually some data I put together. I looked at Kansas City wheat futures for that July contract, that bellwether contract. I looked at the price October 1st and July 1st. And 14 out of 25 years, or 56% of the time, that price was higher in October, about the time we're planting winter wheat, than when we would harvest in July. 93% of the time, that decline was greater than 10%. And so if we're talking a $5 or $6 or $7 market, that can be 50, 60, 70 cents a bushel. So it's pretty substantial. Now, the reason we don't see wheat following that same very, very strong pattern as we see with corn or soybeans is that we're harvesting wheat somewhere in the world almost every month of the year. If you look at where wheat is grown, and both the northern hemisphere, the southern hemisphere, and all the different market classes of wheat. If we talk corn and soybeans, obviously a lot of corn and soybeans raised in the northern hemisphere, primarily in the United States, and then a lot raised in the southern hemisphere, Brazil, Argentina. And so we have opposite harvests, or 2 major harvests a year. But with wheat, it's almost like we're harvesting wheat somewhere in the world every time of the year, or every month of the year. That's why kind of an old adage in wheat marketing that I still think has some strength to it is pre-harvest price a third of your crop, sell a third at harvest, and store a third. I still think there's some value in looking at that as not a bad plan for marketing wheat. Just to take a look at seasonality in a feeder cattle chart, obviously, a lot of those feeder cattle, remember, those are 6, 7, 8 weight cattle, come to market in February, March. In the spring, the market goes down, and then the market goes up and is higher during the time of year that we're basically calving calves and then weaning calves. And so we don't really have that feeder cattle weight ready to go to market. So we do see some strong patterns in feeder cattle as well. So again, one of the things that's a goal for me in this class is to help you put tools in your marketing toolbox. So last week we were able to help you understand forward contracts. That's one tool to pre-harvest price commodities. Today we're going to introduce tool number 2, hedging with futures contracts. So today we want to help you become familiar with futures. We want you to understand margin requirements. If you've ever talked to a producer who has dealt in the futures markets before, I'm relatively positive they talked about margin. And my guess would be they weren't very favorable about it. And so I want to help dispel any rumors. You may have heard about margin, help you understand what happens when you're having a margin call as a hedger, and help you understand that that's not entirely a bad thing and it's manageable. I think I mentioned earlier, I have this class with you as producers today on Tuesdays. On Thursday, I teach the same class with some modification to ag lenders. And so I'm really looking forward to talking to them about margin requirements, because most producers will borrow money for margin accounts. And lenders can get as nervous as producers when it comes to margin. I can tell you we had an experience personally with margin last year. We locked in some futures contracts at 450 to 480. And so when that market went to 5 and 5.5 and 6, we had margin calls. I have, as I mentioned, I think our first class, I work with 3 partners, my wife, my son, and my daughter-in-law. My partners were getting really nervous at some point. So was our lender. And I had to bring them back from the cliff side and say, listen, the reason we're having margin requirements is because the market's going up. That's a good thing. Stick with the positions. It'll all work out at the end. So I want to help you understand that today. And lenders Thursday. I want us to understand how hedging works, and then how to determine the financial outcome of a perfect hedge. And we talked about this last week. That's when we have zero basis. That's a good way for me to start, because it helps you understand the math, because it's easy math when we take basis out. So a perfect hedge is zero basis. Remember from last week, zero basis means futures and local cash prices are the same, and that very rarely happens, but it makes it easy to help you understand how hedging works. We're going to talk about a basis hedge then. So we're going to do the same math, but then we're going to talk about what happens to that bottom line when we have basis, when your cash market is lower than the futures price. And then we're going to talk about a hedge when the market moves in the opposite direction. As a producer, you hedge because you think the market's going to go down. What happens if you hedge and the market goes up? So we'll take a look at that. And then finally, we're going to help you become familiar with the term called cross hedging. Unfortunately, not every commodity that we produce is traded at the Board of Trade or the Mercantile Exchange. But there are ways that we can protect the price of a commodity that's not traded using a commodity that's similar. And we'll show you how that is done. We'll use the example of cross hedging wean calves with the feeder cattle contract. So a way that you can actually do that. So this is a slide you've seen before. Just again, those symbols we use when we talk about futures contracts, months that contract is the contract month, and also the year that it's traded. I do want to spend just a few minutes talking about the most common commodities that we'll deal with in terms of futures trading. So let's talk about corn. So a corn contract is 5,000 bushels. We're going to find that all of the grains are 5,000 bushel increments. That's what one contract is. You'll also find that many elevators or grain merchandisers offer forward contracts in 5,000 bushel increments. And again, that just makes it easier for them to offset that position. You can get smaller amounts. Some grain merchandisers will allow you to forward contract smaller amounts. You have to ask for that. And there are also mini contracts. Those mini contracts are 1,000 bushel contracts. They're traded on the exchanges, but they don't have much volume because people just don't trade those, because the standard is a 5,000 bushel contract. A little trivia question for you. Could anyone tell me why the grain contracts are in 5,000 bushel increments?
What train cars can handle.
Yeah, what a train car could handle. And that used to be the old standard for a grain bin. A lot of grain bins were 5,000 bushel bins. So again, based on a train car. Trading months for corn, March, May, July, September, and December. And again, December is the bellwether month. Prices are quoted in cents per bushel, but the price can fluctuate a quarter cents per bushel or $12.50 per contract, 5,000 bushel contract. Daily limit, and this has changed. I need to change the slide. We are at a daily limit now on corn, I believe at 30 cents a bushel, and then we can go expanded limits. The thing that's probably more important than the actual amount is to understand the concept of a daily limit. When a market hits a limit, either up or down, and they vary based on the type of market, the trading for that day immediately stops. So if we open open trading at 9 in the morning, 9:30 in Chicago, and the first trade was a limit up or limit down trade, immediately the market stops, no trading that day. The whole idea behind that concept of a limit is to keep markets from running away, from making these huge runs either up or down in one trading day. The idea being that that's unusual for a market to trade that drastically. And think of a daily limit as a cooling off time. It's a time for people involved in that market to put their trading hats down, quit trading, go home and think about what's making that market move so that we don't have these movements based on emotion. And today, the other thing that this limits is runaway trading from a automatic trading standpoint, where we have electronic trading for most commodities or all commodities, I believe now. A lot of the trading is triggered by computers and based on algorithms about various things, what's happening in weather, what's happening in the markets. They could even include financial markets. I mean, these are very complex computer programs. And so we don't want to see something happen that triggers buy or sell, and we have all these contracts bought or sold and the market runs wild. So it's an automatic trigger to stop what could happen, or a automatic break that would stop runaway trading from an electronic computer-based trading. So that daily limit's pretty important. And when markets are volatile like they have now, it's not uncommon to hit limit up or limit down. One of the problems with that is if we have a market that's moving very rapidly up or down, it can be a situation where first trade we hit a daily limit, we close trading. So we open trade the next day, very first trade hits a limit, no trading. We can go a few days where all we're doing is hitting that limit up or down, and you can't get in to make a trade because the market closes. So that can be scary if you're on the wrong side of the market, if we go limit after limit after limit. We do see daily limits hit, and it's not unusual to see hit limit up or limit down a couple of days, but past that, that becomes a little unusual. Probably the best story I can tell you about that happening is when, and this is going to date me, some of you in the audience won't remember this, but if you recall when the nuclear plant imploded at Chernobyl, well, that was in a big wheat growing area of Russia, and the wheat market went crazy. And we had, I think, limit up for almost a week. And so if you were on the wrong side of that market, I mean, you sat there for a week until you could finally get in and get out of that position. So they can be a little scary. Last trading day, the business day prior to the 15th of the calendar month. The reason that's important is because this is a contract that can be delivered. If we have positions that go to delivery, then it takes some time to sort those out and to notify the holder of that contract where they have to deliver. Because it's a deliverable contract, you have to have a place to deliver it. And there are several points along the Illinois River. There's big grain terminals, and those are delivery points. So I had alluded to this last week. That's why we won't want to deliver a corn contract if we are a producer in Colorado. We don't want to have to ship corn to the Illinois River to deliver it. So we're going to offset our position. We'll show you how to do that. That'll make a little more sense as we go on. Live cattle, that's a 40,000 pound contract. And again, that relates to how many cattle can you put in a semi. You can see the trading months quoted in cents per pound, daily limit. Again, it's a deliverable contract. This one's interesting for producers here in Colorado. Notice that Greeley is a delivery point. So if you're a cattle producer in Colorado and you trade the live cattle or hedge with the live cattle contract, there may be times you deliver that contract, because hauling cattle to Greeley is not that big of an issue. So financially, there may be times when this is a contract, if you feed cattle in Colorado, you're going to deliver against it. Feeder cattle, this is a financially settled contract. So that means it's not deliverable. It's financially settled based on a formula that takes into account what the live price of cattle is, an average live price across a certain number of states. And so if you don't offset this contract, it will actually cash settle for you, but you don't deliver it. So a little different format with feeder cattle. Lean hogs, this is also a financially settled contract. And again, it's a 40,000 pound contract. Kansas City hard red winter wheat. As I mentioned, all grains are 5,000 bushels. July is that bellwether month for us in Colorado. This is a contract that is delivered. So you can see that we have that last trading day is a little earlier in the month. And the delivery points are Kansas City, Hutchinson, Kansas, the Salina, Abilene area, and also Wichita. Occasionally, I will see producers in the Burlington area deliver this contract. They'll ship to Wichita, but that's not very common. And in most cases, it doesn't make sense for them to deliver. They'll offset it. So questions about those contract specs before we leave that. The reason the specs are important is because we deal in international markets. And I didn't go through the quality specs, but each one of these contracts does specify a grade and quality of the underlying commodity. And so when you trade in a corn contract, if you're a Colorado producer, you know what to expect. If you're a buyer of corn in China, you know what that contract means. And so because that we have these specs and we've standardized contracts, it allows for trade throughout the world. One of the issues that we had during the heyday of hemp was we didn't have a contract spec, and that caused all kinds of problems. So I'm a hemp grower and I say, I'm selling you good hemp. Well, I'm a hemp processor and I get your hemp and I say, this isn't good hemp. I'm not going to pay you for it, or I'm going to pay you less. Then we had a dispute. The problem was we didn't have any specifications as to what good hemp is. It was left up to interpretation. And so that was one of the problems we had with marketing hemp, is we didn't have contract specs. These specs are important. They allow this commodity to be traded worldwide. Okay, basically what is a futures contract? It's really a binding agreement between a buyer and a seller. The buyer agrees to take delivery of the commodity or a financial instrument at a specific future date with agreed upon payment terms. But again, as I mentioned, most futures contracts don't actually result in the delivery of the underlying contract. I've heard that less than 10% of all of the futures contracts, regardless of the underlying commodity, are ever delivered on. And we'll talk a little bit about that later. And again, as we mentioned, these contracts are standardized, and based on that standardization, they're traded worldwide. Futures exchanges are extremely important. Consider the futures exchange to basically be two things. Number one, it's a location where people get together to buy and sell. Now, before electronic trading, it was a physical location. It still is a physical location, but people actively met to buy and sell in the trading pits. As we've evolved and we've got into electronic trading, many of the commodities no longer have what's called open outcry trading or face-to-face. It's all done by computers or through computer electronic orders. But so it serves the purpose of a meeting place, a marketplace. The second major purpose of futures exchange is it's the cop, it's the police, it's the organization that makes sure everyone follows the rules. And if there's a problem, then it's the arbitrator of those rules. Probably a third thing it serves as, I should mention, is it's also the bank, because the futures exchange holds the margin funds for both the buyer and the seller. And as we'll talk about margin can also be thought of as good faith money or your escrow account. If you buy a house, typically you're asked to put some escrow money down or good faith money. That basically means if the house meets your specifications and the seller of the house meets all of their requirements on the contract, that you're going to go through with it as well. If you back out, then you lose your good faith money. So again, a physical place for trading to take place, the cop to make sure that everyone lives by the rules, and a bank to hold the margin account money or the good faith money. Common electronic trading apps handle ag futures options contracts. They do. In the last session, we're going to talk about brokerage firms and how to work with the broker. And so I'm not sure specifically Schwab. I think Schwab does, but a lot of those electronic trading apps, yes, you can trade ag commodities on those. Good question. So futures markets provide two very, very important things for us. First of all, the price discovery. And I may not know what the local price of corn is, or I may not know what maybe my neighbor who's a cattle feeder is willing to pay for corn unless I call him that day, which I could do. But I can grab my cell phone and I know the price of corn, the world price of corn every market day of the year. And that's through the futures exchanges and price discovery. And again, getting back to our hemp example earlier, that was another huge problem with the hemp market, is we didn't have price discovery. No one knew what the true price of hemp was at any given time. So if you don't know the price of something, it's really hard to negotiate a price. So the fact that the futures markets provide for price discovery is very important. Now, there's a lot of times I look the price up on this thing and I don't like it, but at least I know what it is. And I also know what it is in the future. I mean, I can look at the corn market 3 years out and at least have an idea of what people think the market's going to be 3 years from now. Does that mean that's going to be the price? No, it doesn't. It's probably going to change. But at any given time, at least I have an idea of what we think it might be. So price discovery is an extremely important point. And when we deal with commodities that we don't have good price discovery, it's an issue. Alfalfa is a good example. Sometimes finding the true price of alfalfa can be an issue. Pinto beans. I have people asking me all the time what I think the market in pinto beans are going to do. It's tough because I don't have this readily available futures market and that posted price to take a look at. Another quick question in the chat. Let me pick up on that and see if we can answer that. Financial algorithm trading is kind of ruined price discovery because they aren't trading supply and demand, but are trading on other things outside the traditional markets. I think it has an effect. I don't think it's a positive effect necessarily, but what we find happen is as the contract gets ready to expire, the closer, we've got a futures price here, we've got a cash price here. And as we get closer to that contract expiring, those come together. And so even though these electronic algorithmic trading can skew the market, eventually we get back to supply and demand. And so the market will equalize itself out. So I think the biggest detriment as far as computer trading is concerned, in my estimation, is it's added a lot more volatility to the market than we've had before. Sometimes producers don't like that because it's hard to track. It's hard to make a decision. But the other thing that volatility provides for is opportunity. And so markets that just move sideways, which typically what they do this time of the year, which makes market watching in this class pretty boring. Markets that have some volatility provide opportunities on the upside and on the downside as well. The other important thing for us as producers or users of agricultural commodities, the futures market allows us to transfer price risk. And so rather than assuming that price risk ourselves and not having any idea what we're going to receive for a commodity until we harvest that commodity, or we sell it out of the bin if we've stored it, we can use hedging as a way to take our price risk and transfer it to someone else. And that someone else is typically a speculator, or the futures market, typically a speculator in the market. We've taken our risk and we've transferred it to someone else. And so that's a very important thing that the futures markets provide for us, again, as either a producer of a commodity or the end user of a commodity. Okay, we're going to illustrate this a little bit more in a graphic form or a table form in just a minute. But basically, the purpose of this slide is to make the point that futures markets change, on a minute by minute basis. Most of the information we get that has real-time prices on a futures exchange is usually a situation that has like a 10-minute delay. But you can get services where you can watch markets change as they actually change. The point here is that every time the market price change, either going up or going down, the value of that contract just changed. If we were talking about a corn contract and that trades on a 1/4 cent tick, that's $12.50 in value. So if the market goes up 1/4 cent, that underlying futures contract just became $12.50 more valuable. And so every time the market makes a price move up or down, the value of the contract changes. That value of that contracted commodity changes. So let me illustrate that with this table. I think that helps out. So long and short, our terms we're going to define for you in I think the next couple of slides. But let's say we have a buyer of a futures contract. And we'd say if you buy a contract, you're long on the futures market. So I buy day one and I pay $6 a bushel for that contract. Let's say it's a corn contract. On day two, I don't do anything, but the price increases. It goes to $6.10 a bushel. So if I bought something at $6 a bushel and I could sell it at $6.10, did I make or lose money? I bought it at $6. I can sell it at $6.10. I made money, right? And how much did I make? Well, I made 10 cents a bushel times a 5,000 bushel contract. So basically my contract is now worth $500 more than the day I bought it. Let's take a look at that in reverse. Let's say I'm a seller. I sold a contract. I'm now short in the futures market. So same scenario. I sold the contract at $6 a bushel. Day two, I didn't do anything but the price increase. So I sold a contract at $6. To get out of that contract today, I have to buy it back at $6.10. I lost 10 cents a bushel. And so 10 cents a bushel, again, 10 times 5,000 bushel contract, I lost 500 bushels or $500 in that contract. My contract is worth $500 less. So what happened was that $500 that I lost as the short seller became margin call. I wrote a check to my broker deposited $500 in my exchange account. That same day, some buyer had their account go up by $500. And so that clearinghouse function, that banking function of the clearinghouse or the exchange took place. My contract was worth $500 left. So to maintain my position, maintain my earnest money, I've got to put $500 in the kitty. The buyer, their contract went up in value. So they are credited $500. So that was a margin transaction between a buyer and a seller. Questions about that? Pretty fundamental concept, one that's pretty important that you're able to feel comfortable in wrapping your hands around. Okay, we're going to illustrate this a little bit more as we go on. Lots of terminology here. I don't want to spend time today going through that, but I do provide it for you to take a look at. Question in the chat, does a clearinghouse take a fee? And the answer is yes. They take a fee on every transaction, every futures transaction. So when you pay a brokerage fee, maybe you pay you're working with a discount broker and you pay $25 per trade. A portion of their fee goes to the exchange, to the clearinghouse. And it may be very minuscule. It may be, a portion of a cent on every trade. But the futures exchanges are very lucrative businesses. They do quite well. Think about it. Say they only made and I don't know what it is, it's pretty small. Say they made a half a cent. That was their fee on every trade. Think of the volume of trades that go through the Chicago Mercantile Exchange every day. Not only the grains, but the metals and financials and orange juice and all of the things they trade. If they just collected a half a cent on every trade, it's a pretty lucrative business. So yes, they do get paid for handling the money, for their clearinghouse functions, for providing that space for people to meet, even though it's maybe electronic space, for being the policeman, for being the banker, they get paid. Again, futures are helpful for us. Again, it gives us an opportunity to market grain if we don't have a cash market that's where we want it to be, or we don't have an opportunity with a cash market. And again, it gives us an idea of what prices are going to be doing in the future. And although we may not be able to go to our lender and when we put together our cash flow for next year to get our operating loan and say, well, looks like corn's going to be $6. So I'm going to base my whole cash flow on $6 corn. We all know what that market's doing. If it's an uptrending market, we can say, well, I'm going to put in my guess is the market price of $5.50. Futures now is trading at $6. That's a reasonable guess. So it's a way for us to ballpark what we think prices are going to do through that price discovery function, and to at least have an idea of what we think our profit margins might be looking forward. We're going to really emphasize cost of production. This is actually kind of the first page of a very common grain marketing plan worksheet. And notice that it's asking for cost of production. And so that's one of the issues that Ed Usset brought up. One of the mistakes that producers make is they don't know their cost of production. And so that's extremely important. And I tell producers, the best way to know your cost of production is to have really good financial records that allow you to do enterprise analysis. If you have multiple enterprises on the farm, maybe we have corn and wheat and we have a cow-calf herd, we need to be able to determine the cost of production for each one of those enterprises separately, so we can determine that. If you don't have records that are adequate, or maybe your record keeping system makes this difficult, at least try to come up with cash flow cost of production. And most people who are borrowing operating money, one of the financial documents your lender's going to require is a cash flow. So you're putting the thing together anyway. And so that cash flow, you should be able to determine how many dollars will it take to produce that crop this year. And a good cash flow format will include not only your variable costs, but also your fixed costs. So you should be able to get total cost of production. Cash flows also look at the income side. And so you've got to estimate what you think your production level will be, your yields. And based on your expected yield, the number of acres you're going to farm of that particular crop, you should be able to get total bushels produced. So total cost divided by total bushels gives us costs per bushel. And we need that in order to do a good job marketing. As you recall from last week, that was one of the factors we used in evaluating a forward contract. We'd like to be able to sell at a profit. If we know our cost of production and we know what a futures hedge might provide for us or a forward contract, then we can determine if that's a profitable amount. So cost of production is important, and we'll talk about this as we go forward in the class. So what is a hedge? How many of you have ever heard the term, I'm hedging my bets? Okay, when you hear that term, what do you think it means? When you hedge your bet, what are you doing? It's a term we use a lot. Maybe we don't, we use it without understanding. When I hear that term, Rhonda, do you have a thought?
You're covering both sides of what an answer could be.
Exactly. Very good. I couldn't have expressed it any better. You're covering both sides. Regardless of the outcome, hopefully you're going to be okay. A great example is I'm a business person and I contribute money to political campaigns. If I'm hedging my bets, I'm going to give the Republican candidate some money. I'm going to give the Democrat candidate some money. And so regardless of who wins, hopefully I'm on their side. So yeah, we're trying to make sure that regardless of the outcome or what happens, the outcome is good for us. So a hedge does the same thing. So it's a transaction intended to reduce risk. It's taking an equal and opposite position in the futures market to your cash market. And so I'm taking a position in cash and futures, equal and opposite, to hopefully guarantee a desired outcome. I'm greasing the Republicans' palm, I'm greasing the Democrats' palm, and the outcome I want is that they'll take care of me when I need something. So long and short are terms we're going to use moving forward. And it's important that you understand what we mean by long and short. So it is said that you're long in the cash market if you produce the commodity. So if I'm a corn producer, I have corn to sell, I'm long in the cash market. So in order for me to hedge, I've got to take a short position in futures. And to short the futures market, that means I sell it. I sell a futures contract. So that's the equal opposite position. I own the commodity, I'm long cash. To hedge, I've got to go short and sell in the futures market. Okay. If I use the commodity, if I'm a cattle feeder and I buy and feed corn, when it comes to corn, I'm short in the cash market. And so in order to hedge, I've got to buy the futures. I've got to get long in futures. I'm a producer. I produce corn. I'm short cash, or excuse me, long cash. I've got it. I'm long. I've got to go short in the futures market. If I use the commodity, I don't have it. I'm short cash. So I've got to go long in the futures market. What helps me to remember, and I confuse it from time to time as well. I'm going to try to be very careful and not confuse you. But if I remember the cash position, long means I have it. Long means I have the commodity. And so that helps me remember I've got to go short in futures. Short cash means I need it. I'm bringing it in. I'm the user of the commodity, so I've got to go long futures. So for most of us, we are going to be talking from a position as a producer, meaning we're long cash, and we're always going to want to sell the futures market to hedge. So let's go through a diagram of a hedge, and we're going to do it from a corn producer's standpoint, meaning we're long cash. So we have to go short in the futures market. So, and I actually pulled these numbers from last week. So that was what futures were trading last week. And let's say this is a zero basis example. So cash and futures move exactly the same. So let's say that last week, the cash market for corn delivered in December was $5.69 a bushel. And that was actually the same price for December corn at the Mercantile Exchange in Chicago. So I took a position. I sold the December futures at $5.69 a bushel. Long cash. I could afford contracted at $5.69 because that's what that cash corn is worth in my local community for delivery in December. But I could sell the futures at $5.69, and I did that. So by the middle of April, cash is now up to $5.79 a bushel. So the cash market went up 10 cents. Futures market also went up 10 cents. And so now my contract is worth 10 cents less. I bought it at $5.69 in February. To get out of it in April, I would have to sell it for $5.79. I lost 10 cents. And I would get a margin call for 10 cents times 5,000 bushels would be $1,000. Okay, market moves on. We're in July now. Cash corn is 604, which is 25 cents higher than it was in April. And the futures price is 604. I lost another 25 cents. I've got to send a check to my broker to replenish my margin account, my good faith money. By September, cash went down. It's now trading at $5.79. Cash market has gone down 25 cents. Well, I had sold cash for 604 on September 15th. I could now buy it back for $5.79. So I made 25 cents. So 25 cents was deposited into my margin account. My contract is worth more for me. Notice that whatever happens in cash, the opposite thing happens in the futures market. November, cash market went down by, October, another 10 cents. Cash is at $5.69. I had a position at $5.79. It's now worth $5.69. Remember, it was a sell position. So I made another 10 cents. And that went into my margin account with the clearinghouse. On 11/15, I harvested corn, and the cash corn market was $5.59. I bought back my futures contract at that point. And so I've offset it. I sold it to begin with back in February. In November, I bought it back. So I no longer have a position in the futures market. The reason I did that is I sold cash corn. I no longer have price risk. My price is not going to change from $5.59. I don't own the corn. I got a corn check. And so I no longer have price risk. So I no longer need that futures contract. And so I offset it because I don't want to deliver corn. By offsetting it, I'm out of the futures market. I've offset my position. So what was the net? Well, I bought a futures or sold a futures contract in December, or excuse me, in February, a December contract for $5.69. In November, when I harvested my corn, I bought it back at $5.59. So I had a futures profit of 10 cents. I add that to the check I got from the elevator for $5.59. So I sold corn for $5.69. Realize that's exactly what I planned to do way back here in February. Now, in April and in July, I had a margin call. I had to give money to my broker, and my broker sent it to the exchange. I'm getting nervous. I've borrowed that money. I'm paying interest on it. My banker is getting nervous because maybe I've exhausted my line of hedging credit. We need to increase it. And they're thinking, where am I going to get collateral for this? I'm a little concerned. But notice the reason I had to pay margin was because the cash market went up. That's a good thing. My cash corn is worth more. And the scenario I have designed here for you is pretty much what happens. Markets go up and down, but they tend to get pretty close to each other right about harvest time. And so in this case, even though it was a little dicey making that margin call, it all came out in the end. Now, what would have happened if I got really nervous, and maybe my lender got really nervous, and on July 15th, I offset my contract. I bought my contract back. What happens then? I didn't let it go to the end. I got nervous and I backed out. Will I ever recoup that 25 cents I lost? No, it's gone. It's gone. And so the idea with the hedge is to stick with it because it'll come out in the end. And the reason we're getting margin calls, it's not a totally bad thing because the cash value of the crop went up. Okay. Questions about that? It's a pretty important concept. I want to make sure you're fairly comfortable with it.
Does my question make sense? So if you get nervous about it and you don't see the fluctuations that you want, can you carry it over for a couple more months?
No, what you would be looking at there would be what we call rolling to a different month. So you're going to have to get out of one position, establish another. Now you can do that, but typically, again, you're going to lose something in making that conversion. What you're really asking about is there a way that I can lock in a floor but not a ceiling and get out of this thing if it doesn't work the way I want? That's called an option, and we'll talk about that next week. So that's probably what we're going to be able to look at there. Transaction costs, typically what I figure on the transaction cost itself, depending on what you're paying a broker, it's about 3 to 5 cents a bushel. It's a pretty small cost marketing fee. The interest on the note, I mean, that's going to vary with your lender. These are secure positions because you have a security in your futures position. And so it's not like it's an unsecured signature loan. Now, that depends on the sophistication and understanding of your lender to know that. Some do, some don't. Some lenders will try to convince you, well, let's just put your hedge account in your operating account. Don't do that. They need to be separate accounts, because if this thing really runs away from you, you can exhaust the limit on your operating note pretty quickly. And what happens then when you need to pay the fertilizer bill or the water assessment? So I don't recommend, and we'll talk about this in detail later, obviously, but I don't recommend that you have a hedging account as part of your operating note. They need to be totally separate. Good questions. Okay, let's go through some examples. Let's work some math. Now, when it comes to math, all of you know that there are 3 types of people in the world: those that can do math and those that can't. So just so you understand that going into this. Okay, so we're going to give you a futures. This is a perfect hedge, meaning zero basis. We're a corn producer. We're expecting prices to go down at harvest. So that's why we would hedge. So again, I'm using numbers from last week, but today, December 22 corn futures are trading at 569. 569 is above my cost of production. I know that from my past records. I know it from this year's cash flow. So it looks good. I'm thinking prices are going to be lower than 569 at harvest. And frankly, I'd like to sleep better at night. So I want to do something about it. I want to get rid of price risk. And so what I do is sell that contract. I call my broker, or I do it online, and I say sell a December 22 corn futures contract at 569. And I go about producing corn, sleeping well at night, not worrying about price till November 20th. And I'm ready to harvest corn. So I harvest corn and I sell cash corn at 525. Price did go down, as I expected. I buy back my December corn futures contract at 525. Remember, this is a zero basis example. So my local cash corn price and the futures are exactly the same. So what is the net result? Well, I sold that futures contract for 569. I bought it back for 525. So I had 44 cents waiting for me in my brokerage account, 44 cents a bushel. So I told my broker, write me a check. I took that 44 cents per bushel, added it to the 525 I got for the cash market. And so my net was 569 a bushel for corn, which is exactly what I planned for it to be here in February. Questions about that?
I have one for you, Brent. So in the trends you showed us earlier, in that 75% of the time corn goes down into December, and wheat, it's about half and half. Were those the cash price trends, or were those the futures price trends?
That was the futures. Good question. That was a futures market. And so again, typically cash is below futures. We have a negative basis. So we would see the same thing in cash prices. Cash prices would kind of follow that trend as well. Okay, so that's what we hope happens. We protected a price. We expected prices to go down. They did. Now, what happens if we put that hedge on and prices actually go up? Something happens that we didn't expect and corn is worth more at harvest. What happens? How does that math work out? Well, again, same scenario. Today, we could sell a futures contract for 569. That's above cost of production. We think prices are going to be lower at harvest. We call our broker and we tell her to sell December 22 corn at 569. We sleep well at night. We kind of forget about this. November 20th, we harvest corn. Corn is now $6 a bushel. Wow, it went up. Zero basis, meaning the futures is trading at $6. We don't want to have to haul corn to the Illinois River. So we tell our broker, buy that contract back. We want to get out of it. So the broker does that. So what was our net price? So we sold the December corn futures for $5.69, but we had to buy it back to get out of it for $6. So we had margin call. We had margin call at the rate of 31 cents a bushel throughout the time we had that contract in place. But we sold the cash corn for $6. So if you take the $6 we got for the cash, subtract the 31 cents we lost in the futures contract that we paid in margin, we got $5.69 for the corn. My question to you is, did the hedge work?
Yes.
It did. The hedge worked because we wanted $5.69. We got $5.69. Now, would we have rather had $6 any day of the week? Sure, we would have. However, $6 wasn't guaranteed back in December, and I slept pretty well from February through November because I had locked in a price that was above cost of production. Now, the other thing I will tell you, and this will become more evident as we go on, I wouldn't hedge all my crop. In fact, you shouldn't. We recommend you don't. We'll actually help you decide how much of a crop you should hedge. So does that mean I missed out on $6 corn? No, it doesn't. I had some corn to sell at harvest and I got $6 for that corn. But the corn that I had hedged back in February only got $5.69 for that. The other thing I would tell you is as soon as I locked in that $5.69, could I take that to the banker? Yeah, I could. I could say I've got a contract now, so at least for a portion of my corn, I know what I'm going to get for it. And so hopefully that is helpful in, maintaining good relations with the banker and being bankable, especially from an operating note standpoint. Questions about both examples? Again, these are simple examples. We've taken basis out and they aren't real world. We did this just to go through the math. It's what makes it easier for you to understand as we go through it initially. Okay, I'm going to muddy the water. We're going to talk about the real world and we're going to add basis. And remember, basis is the difference between—
Brent, can I ask a question before you move on? Sorry.
Yeah.
I threw a question into chat. So in this situation, like, what's the benefit over hedging versus a forward contract? If I had taken the same 5,000 bushel of wheat of corn and written a forward contract for $5.69 and didn't have to worry about sort of, the money
Right.
going,
Yeah.
the shorts and the longs, right? Like,
So the question is, why would I ever hedge if I can forward contract?
yeah,
Yeah, sure. And that's a good question to ask at this point. Okay, so you may be looking at a forward contract that you analyze and it's not a good deal. For example, the basis may be way out of whack. Okay, maybe the typical basis is 15 under and the contract is 50 under. And so that could be an issue why you wouldn't want a forward contract. We are indeed fortunate in Eastern Colorado, especially Northeastern Colorado, because we have a lot of places to go with grain. Some parts of the world don't. In fact, I have some people in this class this year that farm on the West Slope. They do not have the cash market availability that we have by any means. And so sometimes that ability to for a contract is just not there. I'm personally really spoiled because we do a lot of forward contracting because we have a market that's, in my opinion, the best basis in all of Colorado for corn. And they're 4 miles from the farm. So, I mean, that's a no-brainer for us. But this is an alternative to forward contracting, and forward contracts are either unavailable, which for us is really not an issue, or they're just not a good deal. And typically what causes them to be an issue would be a very unreasonable basis. Okay, good question.
Brent, when you say the best basis, do you mean the highest basis or the lowest basis?
The most narrow. It's the
Most
closest to the futures price. It's a narrow basis, which another way to look at it would be the basis is the closest to the futures market of any elevator in the air or in the state, narrow basis. Usually it's, 10, 15 cents under where a lot of other markets are 35, 40 cents. Now that's just for corn. I can market wheat the same place, and the wheat basis is probably going to be better other places. Wheat basis in Roggen usually is pretty good. Any idea why wheat basis in Roggen, Colorado might not be too bad?
Super close to Denver and Greeley.
Yep, exactly. And lots of wheat milling in Denver. And what's the big one? Is it Ardent Mills? I think that's used a lot of the white wheat. So yeah, proximity to a pretty good wheat milling area. Exactly. Great question, guys. I'm really encouraged by the questions. So let's add basis in, real world situation, muddy the water a little bit. So I'm going to set it up the same way using the same numbers so that you can see what basis does to us. So again, same scenario. I sell that December 22 contract at $5.69. Harvest corn on November 20th. I sell cash corn for $5.15. But to get out of my futures contract, I can buy it back at $5.25. So, and you've got the handout, so I'm not going to ask a question. So what's our basis? Well, we take the futures price of, actually, we should do it differently. We should take the corn price of $5.15 minus $5.25 to get 10 cents under, or minus 10 cents. But basically the cash price is 10 cents under or less than the futures price. So we would say basis is 10 cents under. So what does that do to our math? So I sold December corn futures at $5.69, bought it back for $5.25. So I made 44 cents on the futures exchange. And then I add that to the $5.15 I got for the cash. So really what I sold corn for was $5.59. Back in February, I planned to sell it for $5.69. So you can see the difference between $5.69 and $5.59 is basis, that 10 cents. So as producers, we have two forms of risk. We have price risk that we can do something about with the futures, and we also have basis risk. We assume both. With a futures contract, we have taken care of price risk because we guaranteed a price of $5.69. But we don't take care of basis risk. We still have basis risk. And we'll talk about ways to manage basic risk because there are ways we can do that a little later on. We'll add some tools to your toolbox that deals with basis risk. Now, remember from last week, what was the quality of basis that we said that basis has, that basis risk has, that price risk typically doesn't have? Something that makes basis unique and that's to our favor as producers. Remember what we said about basis. It's relatively predictable. Prices don't tend to be as predictable as basis. So I can look back on a basis table for a particular cash market, look at that 3-year average, and know that basis is around that 10, 15 cent per bushel range. And so when I'm deciding back in February, is $5.69 a price that I would sell a futures contract for and put on a hedge, I could know that basis is typically 10, 15 cents. I could subtract that from $5.69 and know that my net price is going to be $5.59 or $5.54 because basis is relatively predictable. And then I can say, well, would I still want to do that? Is that above my cost of production? Is that a price that I think would be reasonable? I don't think prices are going to go up between now and harvest. Would I accept that? So we can manage basis because it's, again, somewhat predictable. So what we have here is a real world example of what happens when we actually hedge, because we've got to take into account basis. Now, let me ask you another question. Do we have basis risk with the forward contract? No, we don't, because we set the price. That's the price we're going to get, regardless of what happens to basis at the time we sell it. Our price is going to be that contracted price. So a futures contract, or excuse me, a forward contract sets price and basis. We take all the risk out.
So you don't consider the opportunity cost, so to speak, if the basis goes differently than you expected?
I guess you could consider an opportunity cost possibly, but we don't have the risk of basis going against us. And, you know, really, if we look back at the example when the previous example, when price increased, there's an opportunity cost. We locked in $5.69 and we could have got $6. But again, you've got to balance that against, did I market at a profit? Did I sleep better at night? Knowing that, did it help me get an operating loan? You know, a lot of things have to go into that. And again, I'm still going to have an opportunity to sell some $6 corn because I'm not going to pre-harvest price all of it. Would not be a good idea. And we'll show you why that's not a good idea as we go on. Okay, I want to look at the other side of the equation. I'm going to look at this from a wheat buyer. So this is a situation where I need the commodity, I use the commodity. Remember, I'm short in the cash market. I need to go long in the futures market. This could also be a cattle feeder, and I'm buying feeder cattle, I'm buying corn. I would also look at it from this same way. And we'll do the same thing. We'll go through a couple of perfect hedge examples, zero basis to make sure you understand the mechanics and the math, and then we'll throw basis in with the third example, show how basis affects this. So I'm a wheat miller, and I'm going to need to buy some wheat to make some flour. And I'm looking at that May contract, and it's trading at $7.71 a bushel. And I'm just almost sure those darn Russians are going to invade Ukraine, and the price of wheat is going to go $10 a bushel. And I cannot make a profit if I have to pay $10 a bushel for wheat and turning it into flour. It just does not work. And I've got a lot of fixed costs. I've got labor, I've got a building, I've got all this equipment. I just can't make it work. So I call my broker and I tell her to buy May 22 KC wheat futures at $7.71 a bushel. March 20th, I need to buy wheat. My bins are getting low. So I buy cash wheat, and those darn Russians didn't invade, but they got so darn close, made everyone nervous. The wheat price went to $8.05. That's what I got to pay for cash wheat. So I want to get out of that futures contract. So I tell my broker, sell that contract. Again, a zero basis example, futures are trading at $8.05. So what was the net price for wheat? Well, I bought wheat at $70.71. I sold it for $8.05, so I made 34 cents on the futures transaction. I subtract that from what I had to pay for cash wheat, so I paid $7.71 for the wheat, exactly what I planned to do back in February. And at $7.71 a bushel, I can make money turning wheat into flour, so I'm happy. Okay, let's look at the opposite of that. What happens if the price wheat goes down? So same scenario, I buy a contract at $7.71 in March. I've got to fill the bin, so I go to the market. Cash wheat has gone down. Now it's $7.50 a bushel. Not only did the Russians retreat, but they gave Ukraine a plane load of cash for all their troubles. So it was really a great deal. Ukrainians came out looking really good. So I got to get out of my contract. So I sell it back at $7.50. So I bought it for $7.71. I sold it for $7.50. I lost 21 cents on the futures trade, but I only had to pay $7.50 for wheat. So I add those two together and my net price for wheat was $7.71 a bushel. Okay, same question as before. Did this hedge work? Yeah, it is. Now, maybe we would have wished we didn't have it on because $7.50 would have been better than $7.71. However, again, hopefully we slept well. Maybe we had to borrow money to operate for a short term, and the fact that we had locked wheat in at $7.71, which allowed us to show a net profit and a margin, allowed us to be bankable, and we got a loan to make payroll, whatever the case might have been. So even though maybe the outcome would have been better without the hedge, there's some advantages to having the hedge. Okay, same scenario, but let's put basis in. I buy cash wheat at $7.85. Futures are trading at $8. And so we are under by 15 cents, basis under 15. Net price for wheat, bought futures for $7.71, sold it back for $8. So I made 29 cents in the futures exchange, minus the $7.85 I paid for cash. So my net price was $7.56 for the wheat. And I actually did better than what I thought because of that basis difference. And that's an example where maybe basis widened. And as a buyer of the commodity, it favored me for basis to widen. I make money when the basis gets wider, more money. Questions about those examples before we move on? That's really the basis of how a futures hedge works. We're going to talk about strategies a little later. What we've gone through today really represents the type of hedger who puts on a position and leaves it till they sell the commodity. We have some people that use the futures markets. They get in and out of the markets. They'll make a profit with their, getting in and out of the market. They add that to the cash price they pay for the wheat, or the cash price they get for the commodity for their net price. Now that's a little more risky. You could lose money that way. And by getting in and out, as soon as your commodity is not covered by that futures contract, you have price risk all over again. And so what we've just described is using a hedge for the long term. And most people who start off hedging start this way. It's more comfortable. They understand it better. Lenders probably more likely to understand it. And so their purpose in the hedging is to try to eliminate price risk, and a hedge will allow you to do that. Okay. All right, let's talk about another technique, cross hedging. Again, hedging the cash commodity in the futures market of a different commodity. So this is an example where we're producing a commodity, or we're using that commodity, and it's not a traded commodity, but we would like to use the futures market to take out that price risk as best we can. So here's some common examples. If you've ever sold grain sorghum on a forward contract, it was probably backed up by the corn futures. Now, when we first started doing this, we typically price grain sorghum at 85% the value of corn. So when they would offer you a grain sorghum contract, they'd see what corn was trading on the board, say it's $5, and they would offer you 85% of that price based on the feed value of sorghum. That's all kind of gone out the window because China is a big buyer of grain sorghum. And there are times when grain sorghum is more valuable than corn. So you actually might get a contract that would be corn plus so much. But again, to take the risk out of prices fluctuating in grain sorghum, we can use cross hedging to back up that grain sorghum contract with the corn contract. We don't trade sunflowers on the exchange, but we trade soybean oil. So if you're growing oil sunflowers, you might get a contract for those sunflowers that is somehow based on the soybean oil contract. I don't list this one anymore because it's not traded, but at one time there was an 85% ground beef contract traded on the Chicago Mercantile Exchange, and we used that to cross hedge cull cows, but they don't trade it anymore, so we don't. So the one we're going to give you an example of is using the feeder cattle contract to cross hedge or price protect wean calves. So let's give you an example. Let's say that we've got a 300 cow calf herd, 300 producing cows. We have an 85% weaning percentage, which results in about 255 wean calves. We have a 10% replacement rate, so we're going to retain 30 heifers every year. So if my math is right, we're going to have about 225 head of wean calves to sell. We're going to sell steers and heifers. They average 550 pounds of each. So we have a total of 123,750 pounds of calf to market. Now, the challenge to cross hedging is to take an apples to oranges comparison and make a change so you got apples to apples. And so what that usually means is taking the commodity that is not traded, in this case, the wean calves, and making it comparable to the feeder cattle contract. Remember that feeder cattle contract is 40,000 pounds. Also realize that 7 and 8 weight, 6.5 to 8 weight calves on a per pound basis bring less than 5 weight calves. We all realize that. So those are compounding factors. We've got to take an apples to oranges example and somehow make it apples to apples. So what we basically want to know is if we have 123,750 pounds of feeder calf, how many feeder cattle contracts could we sell? Realizing that we have a pound difference and a price per pound difference. So fortunately, some people a lot smarter than me have figured all this out, and they've developed these tables. And this table actually was developed for a Dodge City, Kansas market. I've had, again, people who are a lot smarter than me at CSU tell me this is close enough for most of the cattle markets in Colorado. We can use this information. And so basically we have a chart for feeder steers, one for heifers. Again, the price for a steer is typically a little higher than a heifer, so that's another thing we've got to factor in. But basically what this is saying is, in order to make this an apples to apples comparison, and you have feeder steers that are, wean steers that are 500 to 600 pounds, and you want to sell them in the cash market in the month of October, it takes 40,193 pounds of those calves to be equivalent to a 50,000 pound feeder steer contract. That's the figure I use, the factor I use to take an apples to oranges comparison and make it apples to apples. So if I take that information from table 3 and it takes 40,193 pounds to make a feeder cattle contract, and I'm producing 123,750 pounds. If I divided it by 40,193, I could trade up to 3 contracts. So if I'm a novice trader, I'm just getting into that, we would say just trade 1. You need to learn the mechanics, you need to be comfortable with it. If I'm an experienced trader, trade 2. Now, we'll talk about a little later why I didn't say 3. Why don't we trade all 3? And basically that has to do with the fact that what happens if I have some death loss or the calves don't weigh what they should, I could have some issues with that. So if you're a novice trader, 1 contract. If you're an experienced trader, 2. So here's the example. So, and these are actual numbers, live are real numbers from 2020. I've not updated this, but it's a pretty good example. So July 6, 2022, those calves are out on range. They're growing every day. I'm concerned that the price of cattle, wean calves, is going to drop by the time that I'm ready to sell them in October. So October 20 feeder cattle, that contract's at 137.85. So I call my broker, I tell her to sell on October 20 feeder cattle contract at 137.85. I'm going to sell my cash calves in October at the local sell barn. And so I've got to have 40,193 pounds of calves for one contract, or roughly 40,000 pounds divided by 550 pounds per calf. So that's going to be about 73 calves. That's what one contract would be equivalent to. So on October 28th, I sell my cash calves. I sell them at 145.90 a hundredweight. 73 of those would be actually 40,150 pounds actually sold. I buy back my contract. It's gone down some, not a lot, 135.17. It was 137.85 back when I sold it in July. So what's my return on the calves? So I sold the October feeder cattle contract at 137.85. I bought it back to offset it at 135.17. So I made $2.68 a hundredweight on the contract. So 268 a hundredweight times 500 hundredweights, which is a feeder cattle contract. I actually got a check from the exchange of $1,340, but I want to get that on a per head basis. So if I take that $1,340 and divide it by the actual number of weight of calves that I sold, 401.5 hundredweight, that's actually an extra $3.33 per head. So I got $495 or $195.90 plus the $268 in the futures market. So I actually sold those calves for $148.58. And so it was obviously better than what I would have got had I not hedged. And again, I had price protection from July 6th until I sold the calves in October 28th. And again, the idea here is to show you that this can be done. The trick is coming up with that equation to make it an apples to apples comparison. So you know how many contracts that you can purchase, or excuse me, how many you can sell, and also how the math works out to determine what the end result was and how it affected the bottom line of the commodity that you intended to sell. At one point, there was tremendous interest in this one. That interest has waned considerably because now the Risk Management Agency of the USDA has a program called Livestock Price Protection, or Revenue Protection, excuse me. And it's a way that cow-calf producers can actually buy an insurance policy to protect price on cattle. So we don't see this one being used as often anymore. Questions? We've covered a lot of ground today as it relates to hedging. And typically it takes a little time to get your hands around this. One of the things that is, I think, really positive about how we designed the program is the fact we're recording this. And what I find is the session today and the session next week, when we talk about options markets, are the two that most people go back and review again. And obviously the nice thing about the recording as compared to today, you can speed that recording up or move around and get through some of the other perfunctory stuff maybe I've talked about. But it might be very helpful for you to consider once the recording is posted, going back and reviewing certain things to make sure you understand. Also, feel free between now and next week, if you have any questions that come up, shoot me a quick email. I'd be more than happy to help answer questions that I could.
Brent, what would be a cross hedge for Proso millet?
Let me check on that one right off the top of my head, Rhonda. I don't have a good answer. The problem with Proso is you've got to look at what it's being used for. And in most cases, when we're grazing Proso millet in northeastern Colorado, I think most of it goes to bird seed. So if it's going to bird seed, there's not anything comparable that's traded. You know, the reason we can go grain sorghum to corn, for example, is they're both feed grains. We can go wean calves to feeder calves because they're cattle. We can go confections or oil sunflowers to soybean oil because it's an oil crop. The Proso millet's a tough one because, again, it's used for bird seed. Now, in some cases, it's also used for human consumption. But again, I have the issue of what is it replacing? Because it's not really a wheat replacement. It's more utilized in countries that actually consume grain sorghum for human consumption. So I don't know if there's any way we can tie it to the wheat market or not. The other thing about Proso millet or millet of any kind is there's such a huge price differential. You know, I know we're looking at old crop millet is what, 15 bucks, is it 100 weight now? And so we convert that to a bushel weight and compare that to corn. I mean, there's still a huge price differential. So let me do some checking, but off the top of my head, I'm not very encouraged that I'm going to find a comparable cross hedge for Proso. Great question though. Other questions? Okay, well, we're going to call it good for today. I really love the format. I like the questions. Please keep bringing those up. This really helps me out because I had the feeling a couple of times maybe something I said didn't quite hit. So we had a chance to kind of backtrack or give you a little bit of time to ruminate on it. And hopefully it became a little bit more evident. So anyway, we will call it good for today. I look forward to seeing you next week. We will get the information out as we have your PowerPoints for next week, market reports, and the recording by Friday. Have questions between now and then, please let me know. Have a good week.